Hello, everybody. My name is Sasha Starr, and we start our investment show, Modern Investing with Sasha Starr. Today is Wednesday, 1 o'clock, and let's get going because we don't have a lot of time. I would like to introduce our guests. Let me start with a hedge fund manager, a fantastic investor by the name Shakeel Latimer. Hello, Shakeel. How are you doing today?
Good, thank you, Alexander. Good afternoon. How are you?
Good afternoon. Also, I would like to introduce Jim Eade of Eade-Chess Foundation and Chess Without Border. Hello, Jim. How are you doing?
I'm doing well. It's great to be here.
Excellent. Okay, we have another guest, but I'm not sure if he's already in the studio. So as soon as he will appear, I'll gladly introduce him. So let's start now. We are three people here, and that's what makes investment such a wonderful world. We have Shakeel, a professional investor, hedge fund manager. We have, basically, I would qualify two of us, Jim and myself, as the probably amateur investors more than anything else. I'm never been professional, and now that I'm spending quite a bit of time on this, but I would still consider myself amateur investor, and you, Jim, probably as well. Now, it's very interesting situation in the market right now. First of all, let me clarify one thing, one or two. Shakeel, it would be fair to say that that you are professional fund manager, more inclined to trade rather than invest, or you're doing a little bit of both, or how would you qualify yourself?
Yeah, so I actually run two funds. We're just waiting for final bits of compliance and stuff like that. So we have money committed to both of those. One's located in Singapore, and the other one's domiciled out of Liechtenstein, which is just out of Switzerland. For those of you that don't know where Liechtenstein is, and the strategies in those funds are a little bit different. So, you know, in some cases, yes, it's more about trading, and it's more about, you know, a mathematical kind of thing, you know, of just making very small profits, but very frequently. And then in the other fund that we do a thing called carry trades predominantly. And what a carry trade is, that is where your expected cost of holding a financial security is less than your expected return. So to make that simple for people to understand, imagine if you were to buy a house for $100,000. The bank loans you the money at an interest rate of 3%. So you're paying $3,000 a year to the bank, but you're renting the house out for $10,000 a year. And you might have, you know, $2,000 in holding costs and paying the insurance and all that sort of stuff. So you're paying out $5,000 a year, and you're actually receiving $10,000 a year. So you're actually making $5,000 a year profit. So we do things along those lines, as well as sometimes looking at longer term investments. And it just depends on what's happening at the time. For me personally, my great love is interest rate derivatives. I'm not actually quite sure why I'm good at that. It was just something that just sort of happened, and my career sort of took a different direction to the way that I thought it was going to go once I started getting into interest rates. So.
Excellent. Jim, a little bit about yourself, how you see trading, investments, and how you do it in your particular example.
Yes, my investment strategy has always been that of a contrarian, and I never try to beat the smart money. You know, so I'm never buying things when they're at their absolute lowest or selling when they're at their absolute highest. So I have more modest goals for myself. But whenever I see a solid company being beaten down by news that is coming out, that's short-term news, that's not going to affect the long-term prospects of the company. If I see them being sold at what I think is just kind of a crazy rate, that's what I see as a buying opportunity. And if everybody is crazy about a company that I own and it's going up, up, up to a point that I don't think is rational, then I sell. So that has been my investment strategy, and I call it contrarian because it's whatever the I think there's smart money, and then there's people that trail behind the smart money, and that's what adds to the volume. These people that are buying after the smart money has already bought, or selling after the smart money has already sold. And so I try to go against the large volume of people that are trailing behind in either direction.
Very interesting. I I can't qualify myself one way or another, except that I have two different investment, should I call funds, or at least, okay, let's call it accounts. And I pursue two different strategies. One, where I invest in my opinion, promising stocks, obviously paying dividends. In that fund or in that account, I don't touch companies that either don't pay dividends or pay very little dividends. I just don't do that. So, for example, in that fund, I held, I'm still holding some companies, probably literally obscure names. Well, you know, probably Altria, that's well known. Stock is paying 8.2% dividend and just increased recently. So I hold this. I hold also a substantial position in Gabelli investment and income dividends funds, which is paying over. Now, interesting thing is, unfortunately, it doesn't have options, so I cannot augment my income with options, but it's paying also substantial dividends around 8.5%. And what the beauty is that they're paying monthly dividends.
Yes,
So every, I think on 11th of each month, it's paying dividends.
right.
So I like this proposition, and it had a pretty good run after its low in March, as most other stocks as well. So it's provided nice return on the value of its stock, and of course the monthly dividends as well. Now, Shakeel, once you mentioned dogs of the Dow, I happened to just put a position on one of the dogs, which is horrible company by the name Walgreen Boots. Oh
Yeah.
my God, that's a dog's dog. It's a dog. It's really, I don't know really how to call it. However, I thought that well, I mean, how low they can go? They're paying almost 5% dividends. Not great, not as unlike Altria, for example, but still 5% in our days of 1%. All you can get on is yeah. So 5% looks quite decent, and I think the stock I bought it under $40, like 39 something. So it's now 41, 42 maybe on a good day. So I expecting that slowly it may go up to 45, maybe 50, but nobody knows. It can go down to 35 just as well. The lowest was, I think, 37, but it was about a year ago. It was $60 a share. So obviously there was some adjustment in the prospects of this company. The valuation, of course, competition from Amazon, which is impossible to ignore. And but still, we have a lot of physical locations or so. Now, on my other account,
Sorry, if I can just quickly jump in there.
Yes.
One of the things I think that's very interesting, especially with Dow components, is that there is generally speaking an upward bias, and although it does happen, it's very rare for us to see a company get kicked out of the DAO. When that happens, it's no really big news. Obviously, when General Electric got kicked out and they've been there for such a long period of time. And you do have to be a little bit careful when just judging on dividend yield, because sometimes a company whose stock price is falling or has fallen dramatically will sort of show an artificially high yield. But you are right. When you've got dividends that are paying, and especially the monthly dividends, that can be really great for cash flow. And it might be worth you having a look at some of the ETFs. So you've actually got some ETFs that look at emerging market debt, so bonds and things like that. And because of the portfolio of bonds that they have, even myself as somebody who manages money professionally, it wouldn't be worth it to me to get that kind of a spread of bonds. It would just be simply too expensive. And so if I wanted to have similar exposure, one of the cheaper ways for me to do that is to actually get an ETF. And oftentimes you find that the ETF fees, their management fees, are very, very low. But additionally, there are a number of ETFs that actually pay a monthly dividend, which I think is a really great way of going about doing things.
Well, the Gabelli is, in a way, it's an ETF. It's privately found. He's one of the greatest managers on Wall Street. People always call Warren Buffett and others, but Gabelli, he's in a league of his own as well. He runs several funds, run very well, and they're providing really good returns. And I just follow some of them. So this is really interesting proposition. So now the other fund, or the other account, should we say, if the fund is owned by the same person and it's run by the same person, it's not a fund; it's just an account. But what I'm trying to accomplish is, okay, of course, to make money is number one objective of that. I would lie. Preservation of capital is number one in both funds, in the first one and the second one. By the way, I just sold yesterday. I may regret it that in that fund that I just accounted described, I had a small position in Arbor Realty Trust, which was paying 11.5% dividend, and they have dividends payout pretty soon in the next few days. What I figured out was that once it will pay its quarterly dividend, not monthly, quarterly dividends, that's what they are paying, usually these shares are going down because people got paid dividends. So supposedly they would grab the dividends and maybe go into something else. So I decided to be a little bit ahead of these people. And yesterday I just sold that position at good profit, I must say, and collected some dividends. Now, what you may say is that 11.5%, it looks actually, a couple of months ago, it was 12.5%, but because the stock obviously went up in price, I sold yesterday at 11 and 8. It was in March, it was $5. So can you imagine what yield was at $5? It was incredible. But of course, it didn't stay there long enough at $5. It went very quickly to 7, 7.50, 8, and so on and on and on. So now, yesterday, I just sold it at 11.8. And so sometimes you just do readjustment. But you see, you keep Gabelli collecting 8.5% dividends or so. Let's see your attempt, and the stock went up tremendously. Price from some $11 is now almost 20. Okay, so of course you're tempted to sell. But maybe you should sell, but you just collected monthly dividend, and in 2, maybe 3 weeks there's another dividend that's coming. So how can you, by being a greedy person as I am, how you can forgo this juicy dividend? It's almost impossible to do.
I'd be tempted to take a longer term put option, and your
there are no options on Gabelli. There's no options.
Okay, there's no options. Well, if there's no options, that's a more difficult question. I guess I'm probably unqualified or too qualified to answer that question because I don't actually trade anything that's not optionable. But look, I think I think you have to look at things and go, well, if I've bought in at $5 and I can sell at $11.50 plus I've received this juicy monthly dividend, hey, that's great. Having said that, was it you, Jim, that said, or Nick, or somebody said the other day that they had bought Amazon stock when it was at like $14 or something, and
yes.
was it Nick, and they'd lost money every year. And if you used my theory, one of the things that I will often do when I buy a stock that doesn't have options over it is if the price of stock doubles, I'll sell half of my position, right? Because I've got my money back, and I can just leave the rest to ride.
Absolutely.
But
play with the house money.
Yeah, play with the house money. But of course, it's heartbreaking then when you see the thing go through the roof. You're like, oh, why did they sell then? You know, and I think that it's always a difficult thing because you never actually know. I think, Jim, what you said before about, you know, people try to buy low and sell high, and you hear that all the time. When you talk about the markets, people will say things like that to you. You know, buy low, sell high. I'm thinking, well, thank you. You're such a genius. Like that's how you beat the market. Like I had no idea. The problem is what is high and what is low, and it's really difficult, I think, to make an assessment of that. Just another thing, just as a quick side note, when it comes to dividends. It's a really interesting dynamic in the United States that took me a while to kind of understand coming from Australia. Australian stocks tend to pay reasonably high dividends, you know, comparative to the world. But the attitude in the United States is a little bit different. So with ETFs or certain types of investment vehicles, real estate investment trusts, those sorts of things, they will tend to pay the dividends because that's sort of what they're designed to do. But if you look at a company like Berkshire Hathaway, they've never paid a dividend. And there are a number of companies like that. And the mentality there, and I was quite surprised when I first heard it, the mentality there was that company directors were essentially saying, if we pay a dividend, that's us making ourselves look bad. What we're essentially telling our investors and our shareholders is that we believe that the money is better off in their hands rather than leaving it managed by us. Now, I don't agree with that mentality, but that can be the mentality amongst a lot of very, very large American companies. But the other thing to note there is that tax rates around the world can also have a bit of an effect. Because if you're not receiving an imputation credit, so that's the credit, when the company pays its dividend, that's out of profits, the company has already paid a corporate rate of tax first. So in most countries, what would happen is you pay your marginal rate of tax and deduct away from that the tax that was already paid by the company on that dividend. But if you're an international investor and you don't receive those imputation credits and there's no tax treaty, you can end up being double taxed on the dividend. So that's sometimes a time when an international investor may shy away from a high dividend yielding stock unless it's an untaxed dividend. So just, you know, the things like that to bear in mind. The other thing, Sasha, that you said was about the stock price falling. Now, theoretically speaking, if a company is worth $10 and it pays $100 and it pays a $5 dividend, then when you go to look at the market value or the market capitalization of that company, what is it currently worth? Having just paid out $5, it should now only be worth $95. And so a lot of people will play around with that and say, well, do I think it's going to fall by more than the dividend, in which case I should sell it? Do I think it's going to fall by less than the amount of the dividend, in which case I should buy it or continue to hold it? And there's a lot of what they call dividend stripping strategies that are based around trying to extract the dividend and then playing the market to sort of recover, or the share price to recover from that dividend that was paid out.
I have a couple of amateur questions. First to Sasha and then to Shakeel. Sasha, do you reinvest your dividends or do you take it as income? And
no, I never took it as income. I always reinvested, but not in the same company. When I'm taking dividends, combining with my other investments, I put into something else. And also I have to see in which of these two accounts I would like to do that. So if this account is holding this high-paying dividend stocks, and I'm transferring that to my another account, so obviously I reinvest, but in different stocks or options or something like that. Yeah, sure.
That's one thing that I would recommend to people if you're like me, an amateur investor, is to reinvest either as Sasha does or as I do in the same stock. But these dividends are not something that you're trying to pay your rent with. These are dividends that you're still trying to use to invest.
So just dividends. I mean, if I would have Gabelli, if I would have 100,000 shares, then it would provide me with very significant dividends. I don't
Right.
have. I have 5,000 shares. So, okay, it's a nice thing, but it's nothing that you can travel around the world in business class or anything like that. It's just to buy a plane, maybe. No, it's not. We're not talking about this type of money.
Right. And Shakeel, my question to you is, from what you described about yourself, I really wouldn't call you a hedge fund manager. I would think that you're more of something like an investment fund manager. And in IBMTV, we keep calling you a hedge fund manager, and I don't think we're accurate doing that.
No, so thanks for bringing that up, Jim. Yeah, I think it's probably something that I said in one of my early appearances. I'm sort of as closely as you could call me in the United States. I'm sort of the US equivalent of a hedge fund manager, but I'm not actually an investment fund manager. Sorry, I'm an investment fund manager. It's largely colloquial, but a lot of that has to do with regulations and how they refer to people. So essentially, people, it's not generally people, it's large organizations, family offices, companies, things like that, who invest with me. They have a portfolio. I then have a portfolio of money, and myself and my team can then manage that money, and we try to hedge out the risks. So
Right.
if there was equivalent in the United States, you would call me a hedge fund. But if because I'm not in the United States, I'm not technically a hedge fund. But it's a close enough analogy. But yeah, thank you for bringing that up.
Yeah, does it hurt your potential clients if you're thought of as a hedge fund manager, or is that just something technical?
No, it's just something technical under the regulations. But one of the things that I think the hedge fund industry in general has a real reputational problem with is that there are so many different strategies out there. And, what the sort of theory behind hedge funds, if you have a look at the really old definitions, from the sort of 70s and 80s when they first started sort of being a thing, was that hedge funds hedged out the risk. They had what we would call market neutral strategies. So they should be able to make a profit in sort of any kind of environment. But what's happened is we have hedge funds that specialize in particular types of things, and it's not always a market neutral strategy anymore. And we've actually seen quite a significant exodus of money from the hedge fund industry over the last sort of 10, 12 years. But also I think we've seen a little bit of a lack of trust in the hedge fund industry because, one, they can use very sophisticated and complex instruments and strategies, and two, sometimes they haven't got particularly great results. And the third thing that I will say, just on a personal note, and I don't mean to attack other fund managers by any stretch of the imagination, but if you are Standard & Poor's or Vanguard or BlackRock or any of the other major ETF and fund managers, and you have, for example, you're running the SPY ETF, which is an index, which is an ETF that follows the index of the S&P 500 or IWM or the 3Qs or any of those big ETFs. The expectation is that your ETF is going to follow pretty closely what the actual underlying market is. Now, when hedge fund managers and similar type of fund managers are assessed, there is one of the things that they're assessed on is their returns relative to the market. And you can sort of see what I consider to be quite silly results where the market's turned down, say, 10%. The fund manager only lost 9%. So the fund manager is entitled to a bonus because they beat the market by 1%. I mean, that to me sounds ridiculous. Now, if that occurred within the ETF industry, that would be a different story. I'm okay with that because, of course, there's going to be tracking errors. But when you're talking about active managed funds, I think that seems a little, that's a little facetious. So in my case, we're a global macro absolute return fund. So what that means is that we invest in instruments all over the world. Now, predominantly, I stick to the big countries and the big economies, but we do invest all over the world. So that's what global and macro means. Macro is obviously big. It's the overall stuff. I tend not to get into individual stocks. I tend to take entire market sectors, or I might bet one country against another, that type of thing. So that's a global macro part. An absolute return is a term that's used to try and define a fund that should make money under all market conditions, or at the end of any reporting period, or at the end of any year, should be profitable regardless of swings in the market.
Right. I understand what you do much better. Thank you for that explanation. And Sasha, I'll start with you on this question. One of the things, because you know my philosophy, when things are going up and out of control, I sell. And this happened to me twice in the late 90s, anything with the .com after it was built up into insane values, not related to their earnings, not related to the company at all. All sorts of startups with the .com got funded. And I sold my .coms. And when everyone else in the .com bubble was complaining about how much money they lost, I was just thankful that I had gotten out right before. Same thing happened in 2008 with all the mortgages that were being lent in just a terrible profiteering aspect of it. I sold equities and I got into corporate bonds. But this is how smart I am. One of the corporate bonds I bought was Lehman Brothers because I thought they were too big to fail. And of course they failed. But the strategy of other circumstances guiding you in your investment strategy, because you can't just look at a company and its financials if you're ignoring the bigger picture of what's going on in the world. So how do you play that one off the other? You're looking at companies, you're looking at their dividends, but also you have to keep an eye on what is everything in this sector going crazy? And
Jim, have you done the same thing in February, March of this year? Have you cashed all stocks and bought the bonds?
No.
So
no, bonds don't look attractive to me now.
No. Well, you know what? Instead of generalizing and discussing the macro picture or so on, I'd rather to tell you what's a real world of investment looks like and how I'm trying to navigate it. For example, let me share a screen. You will see now, I don't know how to make it bigger. Anyway, it's just can you see it? It's a company Netflix, which Nikos likes to talk about as a possible investment and as a business model and many other wonderful things. So as you see, Dow today is up 0.59%, and Netflix is up 2.57%, right? Now, I'd like to make this chart. Let's see if you'll take just 5 days. I don't want to go a year long. So if you'll take 5 days,
have a look at the 52-week range. What a huge range from $252 to $575. That is such a massive range for a stock.
Exactly. So as you can see, just if you take just last 5 days, it was as high as $509 just 4 days ago. And yesterday it ended day, I'm trying to navigate it, $466. So it was a huge, more than 10% downside on that. So how I would address this situation, for example, are the money flowing out of Netflix? Perhaps. But where? How? Someone who sells Netflix, he must buy something. He cannot go back and earning 1% on CD. So he must do something else with this money. And what he would buy with this money? What? Like General Electric, maybe? Probably not, because people who buy Netflix, they don't touch General Electric, right? So they would go rather maybe to Tesla, maybe to Amazon, maybe something else, because there is nowhere else to go in these days in stocks. But look at this interesting thing. It immediately bounced back. It's now up to more than 2.5% today. So what that means, and actually all market went down yesterday. As a matter of fact, gold went down yesterday as well, and gold stocks and so on. So I would like to, before I'll go further, I would like to very quickly ask Shakeel, what's your opinion on swings like this, like yesterday's, for example, phenomena on Netflix, gold stocks, and others?
Look, I think the answer is a bit more complicated, and I don't actually think there really is an answer to that, to be honest with you, Sasha. I know that oftentimes what will happen is company directors will think that they've had a really great quarter, and the share price will fall, and they're left scratching their heads going, why did this happen? I think a lot of it has to do with market makers trying to find an equilibrium. But also what tends to push markets, retail traders, collectively can push markets, of course, but what tends to push markets is the flows of institutional money.
Exactly.
And I think that, institutional managers, they have mandates, they have certain things. It's a competitive game, not just from one institution to another, but institutional traders who have worked for the same firm are vying to try and be the best trader and to get the best profits and all that, so that they collectively look quite good. And this was something for those viewers that watched us on Monday that I was talking to the lovely doctor, I forget her name now, Jim helped me out, who wrote a book on working together and sort of trying to achieve a similar outcome. But what you find with these hedge fund managers is
Dr. Gardner.
But you see with a lot of these guys is that they're so competitive and they're just pushing money from one direction to another. And it's not just with Netflix. Okay, so Netflix is a little bit of a nemesis for me. We picked up the stock at this is back in 2018, I believe. We picked up the stock around the 350 mark, and I actually thought it was going to either drop quite significantly or it was going to easily go above 400. And I'd slanted my trade to the upside, got it wrong. It just never went above 400. It dropped all the way down to, from memory, it was something like $2.20, which was absolutely fantastic because we made a bundle of money out of it, even though I got the position wrong, just because of the way that we trade. So we made a whole heap of money out of it. I rode it all the way back up to $3.75. It came back to $3.50. We closed out, made another bundle of money, all decided that we will always be subscribers of Netflix no matter what, because we made so much money out of it. That's the least that we could do. And I sat there and just watched it never get above 400. And then, every time someone would say to me, "Oh, do you know what Netflix is?" I don't want to know. And then when I heard it was at 5.75, I just like, really, but that's trading. I mean, that's the way things go. But if you look at things like gold, which is supposed to be a safe haven, we've seen gold prices go to really extreme levels.
Yeah.
A trade that I
over 2,000, yes.
Yeah, a trade that I've done recently, and again for those viewers, please don't try to replicate what I'm doing. This is a trade that I may or may not still be in. But a trade that I did was shorting the 10-year notes. So what had actually happened was the 10-year notes were up above $1.40. Now, we actually made during February, and I ordinarily don't like saying this because I don't seek to make a profit out of the suffering of other people. But when markets become volatile, there are profits that can be made. But I actually made, I think it was something like 70%. On my private account. So this isn't the professional accounts that I manage. It was a private account that just myself and some friends have. And we made 70% over a period of a couple of weeks on the notes because I thought that above 140 was too high, because that implies that interest rates, for it to go any higher, would basically imply interest rates sort of going into negative territory, which I don't think the US would allow. So I bet against that happening. We took like 70%. I stacked that portfolio very, very heavily in a way that my risk managers, if I did that in my professional, management accounts, they would be all over me, and I would totally, not be allowed to do that. But of course, with my own money, I can do what I like. And so, we made a really good return on that. So earlier this week, I had a look at the 10-year notes again. Yeah, they're up above $1.40. They're currently trading around 139. So again, I shorted the position there, the futures contracts. I gave it a bit of time, so I shorted the December contracts, and they fell a point, which is a really big move in the 10-year notes. So yeah, I think when you look at movements in individual stocks and even individual sectors, trying to decipher why they've moved up or down or why they're not moving at all. I just don't think there's an easy answer, because I think that the institutions, it's about them pushing money to some sectors of the market and pushing money away from it. The other thing I'll just quickly say is tech is just so outside my sphere. Perhaps Jim, being in San Francisco, you might understand tech a little bit better than me. I know I'm relatively young. I just don't get it most of the time. But a company like Netflix, you would imagine that they've had a lot more subscribers, not just in the US, but all over the world, because of the fact that people have been sort of stuck at home. But I was very interested to see Amazon's last quarterly financial report, because Amazon's the amount of product that they've been selling has gone up quite dramatically over COVID. I'm pretty sure that 100% of that increase is because of me, because I sit here and just buy crap because I'm bored, and I'm just buying all this stuff, and it's free delivery with Amazon Prime, and I can get stuff from the US sent over. It's brilliant. So I'm buying like cans of baked beans and stuff I don't need, stuff that I can just go down the shops and get, but it's delivered, and why not? But one of the things that was really interesting was that although their revenue had gone up, their profit hadn't. And one of the things that they mentioned in their report was that the cost of deliveries had also gone up by more than what the revenue was. So they actually hadn't made an awful lot of profit, or an awful lot extra profit. With a company like Netflix and some of the similar sort of streaming services, an increase in the subscriber base doesn't really cost them an awful lot more, as far as I'm aware, in delivering that content. The really big and interesting question for me is, what happens if Russia has made a claim that perhaps they've found a vaccine. There is a few claims about vaccines potentially being developed or that sort of thing. In the absence of that, I actually think that testing might help. If there's technology that helps you to be able to say get tested instead of having to wait overnight for a result, you can get your result in an hour. Then perhaps you show up at the airport an hour early. They test you, they clear you, then you can go and you can jump on the plane. Everyone's been tested, and then the world can sort of open up a bit more again. So that's something that would be great. Any of those kinds of things that's going to help to open up the world again. The question is, do people then keep their Netflix subscriptions, their Amazon Prime video subscriptions, et cetera, or do they start to say, I don't need them anymore? I think that there'll be a lot of people that will cancel them. And I think there'll be a lot of people who, like a good membership, will sign up for it and just never quite get around to cancelling it until their credit card expires. And they go, I don't need that anymore.
Okay, that's great. You described both points of view. Why yesterday people sold all the Netflix that they have, and why today people bought all the Netflix they could handle. Exactly because you've done a great reasoning for both cases. However, I just wanted, as an illustration, I just wanted to tell you how I played that move. What's happened yesterday? I initiated two positions. One, I sold 3 September 18, 460 puts, but also I've purchased 2 September 18th, 450 puts. I've got nice premiums, and of course, because I sold 3 and bought only 2, so of course I took a little bit more risks than I should have, but I think I initiated quite healthy position, and the worst case scenario, it could be that I will end up purchasing Netflix for $60 minus $16 what I've collected, minus money that I will make on 2 puts that I bought. So my cost of Netflix will be, at the end of the day, less than $440 a share. I'm ready to go along with that. Plus, once, if and that will happen, I will sell covered calls probably to get a little bit more cash to compensate me for my struggles. But I think it's a nice move, which hopefully will end up in a profitable position overall.
I
Would
would
you?
like to mention one other factor. One other factor in Netflix. The reason that scares me is because in this COVID environment, there are so many streaming services that are just getting off the ground. Many of them will fail, but some of them will become very, very popular. So I think there is going to be competition that Netflix is not facing today, or more competition than it's facing today, and that might also have an effect on its stock price. But that's looking at what's happening in the world and making my decisions based on what's happening in the world, and then my decision about an individual stock. So that's what I was asking about earlier.
Sure. Thank you, Jim. You know what? You know my position. I never marry to a stock, any stock. It's not my wife. It's not my lover. Right. It's nothing. So the Netflix, I love Netflix at 430, and I don't need Netflix at 495. That's about it. And all I know is that this position, especially as there is a time decay, so all I need is to survive and be alive by September 18th to to get my profits and get them to the bank. Now, in order to really evaluate competition to Netflix, you know what? I don't really care about the competition. All I need is to know what are Netflix prices. However, if you're taking a longer look, say 2 years from now, 3 years from now, I think the real competition to Netflix will be in the hands of Disney, maybe Apple TV, maybe some other substantial companies, not from streaming services. They have nothing. They don't have content. They have really nothing to hurt Netflix. Because it's, first of all, they already have a great distribution base, subscribers base, great programming, some libraries, and so on. So the only really people can hurt them. It's Disney. Disney's done actually quite well on the subscribers base.
Yes.
But you see, Disney is, they have so many other components like Disney parks, and which are closed, and so many other things which are very difficult to evaluate. Otherwise, Disney would be a good buy, and maybe it is.
I did buy it. And because when it came down, all the things about its park closing, and this is one of the examples I was talking about, when all this bad news came in, Disney's stock plummeted. But Disney has all this material, and it's going to be okay. So I bought it.
Yeah, but Disney's good stock. I sold some puts on Disney, trying to also buy that stock, but it went away, and I just kept the premium. So I participated a little bit in Disney story in my own way. Didn't make a lot of money, but some. That's about it. So right now I'm still watching Disney, but I just can't just, you know what, I found that either I'm too lazy, or for some reason I don't really buy the stocks anymore. I'm just having all kind of strategies, whether like to buy puts or to even if I would buy stock, I would still sell some covered calls or so on. I'm just no, I'm not brave enough. You know what? I think I'm just just to be.
If I can just say about your strategy, Sasha, and you know I'm going to say this, because I'm so risk averse. I don't like being what we call naked. So you've got that one naked put, and especially on a company like Netflix that I know can swing so much. And we brought up the 52-week graph; it's gone from 250 to 575. So it would make me nervous to know that I could end up exposed that way.
I can buy that put right now while we speak.
Yeah, well, I always try and do a spread trade of some description so that there is a limit to how much I can lose if things were to really go badly. It's interesting what you say about Disney, Jim. So we have a company here in Australia called Ardent Leisure Group. It's been a while since I looked at their share price. I was just trying to Google them now. So they own theme parks that are kind of similar. It's totally different, but kind of similar to Disney. And they're sort of the premier, parks here in Australia. So everyone in Australia sort of wants to go to them. They're up in the far north, though, up in Queensland, and far east north, I should say, northeast. But a few years ago, they had a really tragic accident, and
Oh yeah.
it was a. Did you guys see that on the news over there?
No, but I know that what you're talking about in general, because they're always these things. These amusement parks are always susceptible to that.
They are. We have, I think, stronger regulations and safety rules around these sorts of things than in the United States. So I was actually quite horrified when I saw the rates of injuries in the US compared to, say, in Australia. It's a relatively rare thing. Also, the park in particular that I went to was one that was called Dreamworld, and I'd always wanted to go to it as a child. So on my way to Fiji, I actually went to it, and there was this big storm, and so that ride that those people tragically lost their lives on, that was actually the last ride that I was on at Dreamworld. So really, scary thing. But what actually happened was their stock price took quite a significant dive,
Right.
as a result of that. And I looked at that and thought, they're going to recover from that.
Yeah.
I'll put some new safety regulations in. This is, it's tragic that it's happened, but when these sorts of things happen, that's how they make a lot of things safer. Sometimes there's things that you just don't see, and then you're able to make things a bit safer because of it. Now I've just looked at their share price, so it actually did go back up by about 50%. At the moment, the share price is down at 42 cents, but that's obviously because of the lack of tourism. But Ardent Leisure is one of those companies as well that people in Australia don't realise, I think, sometimes that when the Australian economy isn't doing particularly well, and when the Australian dollar is falling, that all of a sudden makes us a lot more attractive to other people to come for a holiday, because Australia can be and is actually a relatively expensive country to come to. And the US can actually be. I mean, we tend to get the impression that the United States is a reasonably cheap place to go shopping and things like that, but that's not always the case. If you're, I bought this polo shirt in Florida, I think, and it was around $100 for the shirt, and that was on special. That was the sale price. So you're not going to get it any cheaper here or any more expensive here. It was about the same price internationally. It depends on what you're buying, I think. But of course, when the Australian dollar was up at like $1.15, $1.17 against the US, the US was the place to go because it was so cheap comparatively to to us. So you start to see those sorts of flows as well, and so that's why I think when you're looking at the market, you're looking at individual stocks and shares. Remember that the US market is open to everybody in the world to invest in, and so one of the things that also will occur that will actually move market prices sometimes isn't particularly obvious. It sometimes is because if I'm an investor, for example, in Japan, I'm looking for yield because the yields in Japan have been low for such a long time. They've had a deflationary situation there for such a long time. So I'm looking for yield somewhere else. But if all of a sudden I'm looking at the US dollar and I'm thinking the US dollar might start to fall, it might be time for me to pull my US dollars out, liquidate my portfolio, even if the share price went up, because it's cheaper in my own currency to buy those shares at a higher price in a week's time than what it is for me to hang on to it now. So that's why I said it's a very complicated thing to try and predict why or explain why particular things are happening, because there's just so many different players, there's so many different institutions around the world with so many differing reasons, and you're never going to know what they are.
I agree with you, Shakeel. What I'm trying to explain, at least what I'm doing and what you and Jim agree or disagree with. Two reasons. Number one, the retirees in the United States, as well as in Canada, the option to put your money in CDs for 1 year paying 1% is not an option. So you get your message that, okay, you just do or die. Okay, either you put it for 1% a year, which is not nearly enough to support your lifestyle and to have meaningful, probably trips around the world or something like that. So you're almost forced to go out and invest in stocks or indexes or just anything. But to beat 1%, get at least 2%, 5%, 10%, 20% if you're very skillful in what you're doing. Okay. So that's number one. Number two, younger people, there are scenarios that for a long time, the job market will be very weak, especially for younger people with no experience, and they have to get ahead in their lives. And sometimes maybe the only meaningful thing what they can do in the meantime, waiting for a good job offer or something, is trying to augment their lifestyle with the higher than usual returns from the stock market. Stock market will be there forever. Whether it will drop down, Dow Jones may drop down to, I don't know, 5,000, or it will go to 50,000, doesn't matter. The market will be there always, tomorrow, next month, next year, next 10 years. So if you have some talent, experience, skills, and you can extract from the market where the trillions of dollars being traded daily, your few $100 a day here and there, or a few thousand a month if you can. So that can, in some cases, I believe, could make people financially independent. So they don't depend on their parents, their job, whatever happened, the coronavirus, or whatever. It doesn't matter really what it is, but they can be confident the market is there. So every day when the market opens at 9:30 or before that, you can already make some trades and try to do something to augment your lifestyle, to earn some money. And it's not for everybody, I must admit. It's not for everybody. But there are some people who can do very well. What I'd like to do, I would like to share a screen again with you.
Let me just quickly just address something there, Sasha. For the older people, I think, yes, that's really important that they try to do something to enhance their retirement. But I certainly think that they need to be very, very careful and have first and foremost in their mind capital preservation. I think
what I'm talking about almost every day except today. I haven't done
younger people, I think, can take a little bit more risk. But unfortunately, and I might be slightly wrong on my number here, but I think that to be a day trader in the US, you need to have around 25,000. It might be 20. I think it's 25,000. And for a lot of young people, if you're 18, 19, or if you've just graduated high school or are going to graduate high school in 2021, is the coronavirus going to be over? And if it is, you know what? Now all of a sudden you're 18 years old and you've got this mega workforce or this huge amount of people that are applying for the same jobs as you are, and you've got no experience, you've just finished high school. So that's going to be really hard, I think, for a lot of young people. But what I will say, just as, and again, it's not financial advice, but what I will say to people is when they first start out, just stick to the simple strategies. Learn something. There are people that I know who just focus on 3 or 4 companies, and that's it. They just know those companies, they watch those companies, and they just trade those companies up and down, and that's all they do. And there's nothing wrong with that. If you can make money, then who cares what somebody else is doing? Just focus on that.
And why I would strongly agree with you, Shakeel, is that you see many companies, they have the same market maker day in, day out. Let's say Microsoft. There is a market maker at Goldman Sachs who does nothing but trading Microsoft up and down, and selling at certain price and buying back. And remember that the market maker on Microsoft, let's say he starts day. He has, say, 50 million shares of Microsoft, and let's say he has $100 million cash. Now, at the end of the day, his cash position will, of course, variable, depends on his skills and the market conditions and so on. But he must end a day with the same 50 million shares of Microsoft as he started the day. So if he's oversold during the day, the Microsoft because of supply, so he was not that skillful because he had to raise prices and maybe he failed to do so. So he ran out of stock. He has now 45 million shares of Microsoft. in last 5 seconds of trading, he must get this 5 million shares to end day with the same 50 million shares of Microsoft. That's what market makers are doing. Now, another thing is
that's not quite. It's not quite as simple as that, though, because they can use synthetics and they can use other derivatives to replicate the position, as we discussed last week. So
I agree with you. I'm talking about time, say around first half of last century. Of course,
yeah.
from 70 on with the derivatives and options and so on. Yeah, you're absolutely right. But the idea,
Sasha, I'm 36. This
okay.
half of last century. I'm 36. Come on now, be nice.
Okay, now another idea what I'm trying to pursue these days, if I can share a screen, I will show it to you. Okay, I've got the screen here. About a couple of days ago, I started to build up position in a so-called, it's a symbol TZA. I don't know if you're familiar with what it is. It's a triple small cap bear index. Jim, are you familiar with that?
Yes, I can see it.
And Shakeel, you are?
I can see it. Yeah, I haven't looked at this one for a while, but I always get nervous with the multiple bear or multiple negative indexes, because the tracking errors on them can be quite high. But I'll let you talk about it first, and then perhaps we can come back and talk about the tracking errors.
Yes. Okay. I'll talk about it, so then you can have an ammunition to criticize me. But listen,
I'm curious you. Look, as I said, if you're able to make money, stick to what you're doing and just keep improving your strategies as you go.
okay.
And I said everybody,
Okay, here is this index for last year. As you see, it goes all the way down until it spikes, of course, in March, beginning of April. And then, of course, it started falling again because market started to recover. So it goes exactly opposite where the market is trending. So why? You see, I have a lot of, for example, Netflix. Obviously it's a very bullish trade which I initiated, because my scenario is that Netflix by the 11th of September will be $460 or higher for me to collect my premiums and make money. However, and I have a lot of other bullish positions, like I have Microsoft. I have several other positions. However, here is one position that I initiated just last week. I started to, and you know what? I'm not even buying the shares of TZA. What I'm doing is the same thing as you might anticipate it. I'm selling puts. I sold several puts of. Let me think first. Okay, where's my position? Okay, I sold many puts on October 16th. Puts. The exercise price is 20. So the TZA is now only 15 and a half or something. So since I initiated position, it was slightly lower. It was 14 something. So I'm in the plus territory right now, but that's not what I'm trying to do. I'm trying to hold on to it, and I even prepared to anticipate some losses along the way. But I'm preparing to possible market downturn, quite substantial downturn, and around probably September, October, maybe even November time. So I'd like to build nice position in TZA because it may go way higher than 20, go to 30, 35, maybe much higher. Depends on how severe will be the market drop. Okay, now please, it's your time to criticize me.
No. I'm not
Hit it.
Well, we'll have to get off the share screen so we can see each other again. No, it's your fault. I can see the two chess players ganging up on me on the the King's Gambit, so I have to get my stuff going. No, it's not criticism of you. It's the bearish ETFs sometimes have some pretty significant tracking errors, and actually, and please don't quote me on this to the viewers. Somebody will look it up and go, "He's wrong." I think it was 2017. It might have been 2018, or it could be an entirely different year. Two different short ETFs actually went under because of just how big their tracking errors were. So that just concerns me, and I've tended to find that you can actually take a synthetic short position and the short position on the ETF and make money from the difference just by banking on the tracking errors that they have. But look, I saw the 52-week thing there, and I'm slightly rounding. It was the low price was at $15 and the high price was at 120. I'm rounding that a little bit. Selling put options against that. That seems like a reasonable play, to be honest. It doesn't seem like, how badly could you really get hurt? One of the things I'll just say, when we talk about naked positions, I guess one of the things that I should really point out, to especially to the viewers who are watching. So what I would prefer to do is to, rather than just sell a put option, I would sell a put option and I would buy one below it just to protect myself. And that's what we call a bull put spread. So it's a put spread and bull means that we're hoping for it to go up. If it sits flat or goes up, then you actually make some money out of that trade. If it does go down, there's a limit to how much you can actually lose. So that's the way that I would prefer to do it, because it limits my risk. And I would say that would probably be quite an effective strategy on this particular stock. If you are going to do what I've referred to as being naked, it doesn't mean you're going to a nudist colony in Florida or California. Do you still have them over there in California?
Yeah.
The French Riviera. That's not what I mean by going naked. Going naked is where you've actually sold short a derivatives position that potentially exposes you to unlimited risk. If you've sold a put option, obviously the limit is zero because stocks can't fall below zero. If you are going to do that, which sometimes can make sense, what I would say is have a look at your maximum risk really, and have a look at that as a percentage of your portfolio. So you don't want to be selling put options where if you got hit because the company went under altogether, that's half your portfolio wiped out. Because mathematically, if I lose 50% of my portfolio, I have to make a 100% return just to break even on the rest of my portfolio. So that's the only thing that I'll say. If you're only allocating 5% of your portfolio to this, where you've written some put options naked, and if you got hit and absolute worst case scenario, the whole thing went to zero, that's only 5% of your portfolio. Well, that's not such a big deal. You've only got to make 6% back, and you're back to even.
Shakeel, what I'd like to just mention one peculiar thing is that I've collected $6.40 for each put that I sold, and the TZA now is $15.43. So first of all, I don't understand scenario under which that can go to zero. Is it possible that the TZA will be a zero in a month, in a year, in 10 years? How that could be a zero? Because the market always has potential to go down, and there is always some kind of, okay, it can go down to $10. Let's agree on that. I have no problem with that. So if I collected $6.40 and by October 16th, if I'm right.
What was the strike price when you sold the put?
$6.40.
What was the strike price? You got in premiums 10. Oh, look, I'd probably take that bet. I would probably take that bet.
Primarily, I'm not so much interested to make this money on the options that I sold, although that's nice too. What I'm interested is to have overall protection to a portfolio where I have a lot of long positions, even like Netflix, for example. If the market will all of a sudden, what is the Dow, 26.5? What if it will collapse down to 18,000 or maybe 15,000? It's a very possible scenario. Anything, the new coronavirus or Trump is losing election in all 52 states and so on. There are a lot of calamities that can happen. And the probability is not zero. It's slightly over zero. I think that is much more probable than TZA going down to zero in value. So instead of
Yeah.
buying at 15 and a half, like it's trading today, which is probably not so bad idea in any case, but I'd rather sold this puts. So if it will go down to $20, I'm still in the money. I'm still making good money if that was the scenario. But what's happened if it will go up to $25? I'm not talking about 40 and 100, which was happened a few months ago, right?
Look, honestly, if you're selling $10 strike options and getting $6.40 as a premium, that would be a bet that I would be prepared to take naked. To be honest with you, I
Absolutely.
would. Again, I wouldn't put my entire portfolio onto it, but I
No,
would
no, 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 no.
of it, and I would do that. To answer your question about how could it get to zero, look, there's really only a couple of ways that I can see, but the main way is because of mismanagement within the ETF itself. It's very hard when when you have a bear ETF, so that's an inverse ETF. That means that if we're talking about the S&P 500 for the sake of the viewers, the S&P 500 goes up 10%. The bearish S&P 500 ETF, that goes down by 10%. That's the theory. But
Yeah.
when you start doing it in multiples, so that would mean that if the S&P 500 goes up 10%, the 2 times multiple goes down by 20. If it goes down by 10%, it's a 3 times multiple, it should go down by 30%. Now, in really bad events throughout history, the Great Depression, the coronavirus, September 11, the Great Recession, the Asian currency crisis, you can name them all. You generally don't see the market dropping by more than about 30, 35%. Sometimes you're maybe pushing 40, and that's about it.
Right.
The interesting thing here is that if you were to actually use this, not the way that you're using it, because the way you're using it, hey, that seems to make sense. And next time you see that, can you text me, please? Because I might put some money on that. That would be a good trade. I completely missed it. I would have done it in my personal account. But one of the things that I would say is that sometimes people use these as a hedge against their actual portfolio, and the problem with that is that let's say that I own $100,000 worth of whatever market that's following, and so I only buy $30,000 worth of these, thinking that if I get a 30% drop, this will triple in value, right? But if it goes up, will it go down by that? Well, it doesn't quite hedge. It doesn't perfectly match, and that mismatch is where there's profit, because theoretically speaking, if it's at $10, the market's really only going to drop by 35%. So all you need is another calamity right now, and the market drops another 35%, which hasn't really ever happened in history, but just as an example. And theoretically, a 35% drop should knock out all of the money they've got, but it wouldn't, because they're not going to track it in that way. So it's kind of an interesting dynamic when you look at the multiplying, even the ones that multiply to the upside as well. So I've tended to have a look at say buying the S&P 500 ETFs and buying some of the ones that are like the 2 times S&P 500 ETF, and you do observe a lot of tracking errors. The other thing I'll say with ETFs, and just something for the viewers to know, the last few times I've been to Bloomberg meetings that have been held, or events that have been held by Bloomberg, I've actually had the great opportunity to meet with a lot of ETF managers here in Australia. And one of the things that they talk about is that ETFs are something that were born from government regulations, governments really wanting people to have access to diverse investments without having to be blind because hedge fund managers won't reveal their strategies. But one of the big things is that hedge fund managers and institutional fund managers are very, very averse to ETFs. They don't seem to want to put a lot of money into them. And I have to actually put my own hand up for that, because I used to say, unless you were in a really dramatic situation where you needed to get exposure really, really fast, there is absolutely no reason for you to ever buy an ETF. Well, there's very few reasons why you'd buy an ETF. I talked about emerging market bonds ETFs. Yeah, I'd probably take those because that's too expensive for me to replicate. But for me to buy an S&P 500 ETF when I'm a fund manager and then charge my clients a performance fee for having simply gone and bought an ETF, that that just sounds like, what do I do for a living? I do nothing. This sounds terrible. And I think that this was probably a quite prevalent view amongst institutional investors. But there is actually some really great ETFs that are out there. But there isn't a lot of institutional money going into them. And so because of that, there's actually a lot of opportunities by playing one ETF against another. And the one that I was talking to you about before, and I can't quite remember the code for it, I think it's PEF. They were paying, and it's been years, it's been like 4 or 5 years since I've looked at it. But back in those days, they were paying something like a 12% dividend yield, and it was paid monthly. And if you can, if sort of, for those people who are sort of in their retirement years, if you can look at its chart, and if it seems to be at a fairly low price on its historical price, again, you don't put your whole portfolio into that, but if you can put some money into that, that's nice, because you're getting that money paid into your account each month, and that gives you that cash flow. And I think for people who are older, the baby boomers and the older generations past them, that's what they're looking for. That's what they need, because they're not saving up to buy a house. They're not trying to raise children or worry about how they're going to afford that big wedding that they want to have. They just want to have the money to be able to enjoy their retirement, maybe travel around Europe or travel around the US, all that sort of stuff, help the kids out, buy some Christmas gifts for the grandkids, all that sort of stuff. That's what the older generation are about. It's more about income and lifestyle for them.
Even to have a nice cigar. What's wrong with that? A nice bottle of wine. Now, I want to put your attention to something interesting. Right now, I'm not going to share the screen, but you can check it, trust me. The TZA is today down 0.6%, okay? Actually 55 as we speak. Now, the Dow Jones today is up almost 1%. It's plus 0.95%, so almost 1. So how is it possible that Dow Jones is up almost 1%? So in a way, if it's 3 times bear, you would expect that the TZA will drop 3% today. Wouldn't you agree with me?
No, because the direction ETF that you showed was a small cap. It was 3 times stocks.
Done again. There is a close correlation between Dow Jones and small cap, but not 100%. I agree. So, so in a way, then this TZA position is even more favorable than the short S&P or Dow index, because small cap stocks probably will suffer even more if calamity will happen. And actually, what I see, the way it trades, I can see probably tomorrow and maybe Friday 2 down days from the market coming.
Can I just say this actually came as quite a big shock to me. That was something that I had to learn, because I couldn't work it out. It just blew my mind. We saw like the worst, like most dreadful companies that you'd ever come across during the Great Recession. They went through the roof. And I mean, like, you saw some companies that had like 1,200% returns, like the stock price had gone up like 1,200%, in a matter of weeks. And you're looking at these companies going, who's buying this? This makes no sense. I don't get it. And it took me ages to kind of work out what was happening. And what it was is, I think people have heard me talk about before, the market neutral strategies is where you buy stocks that you think are going to go up, and you sell short stocks that are going to go down. And if you're a portfolio manager, and let's say that you've bought $100 million worth of shares, so your cash position is minus $100 million. But if you've short sold $100 million worth of stock, you've just received $100 million, and so now you're short the stock, which at some point you'll have to buy back, and you're long this other stock. And what you're hoping for, so your cash position is square. You've still got the 100 million cash sitting in your account, and you're earning interest on that cash. You've got a long 100 million and a short 100 million, and what you're hoping for is that the differential between the two doesn't, the short stuff doesn't come up to meet the long stuff, right? You're hoping that spread widens. But during the Great Recession, there was a big liquidity crisis. And so what happened was all these hedge funds were having clients redeeming. And what did they have to do? They had to unwind their positions. And so to unwind their positions, they had to sell all that stock that they thought were really good stock. So you saw some of the best companies just having these oversold conditions where they just were slamming down way past rational prices because these fund managers had no choice but to liquidate. And you saw the worst companies that you could possibly think of going up by 1,000% and 1,200% and 500% and stuff like that, which makes no sense. But the hedge fund managers and institutional managers all had to buy back their short positions. And, they all tend to do, or a lot of them will tend to do the same sort of stuff. So they're all holding the same stuff. So they're all competing with each other. I want to buy the worst stock I can possibly buy, and so do you. So we're going to outbid each other on the worst possible stuff. I mean, this is sort of what you saw happen. Now, I should know this off the top of my head, and I don't. But there's a type of there's a type of technical analysis which actually measures how poorer companies are faring versus better companies. And they actually look at it by sector, which gives you an idea that if, for example, you're starting to see weaker companies begin to falter, but the best companies haven't faltered yet, that could be an indication that the market's going to start to turn, because obviously the weaker companies go down first and it takes a little while before the better companies do, right? Or if the better companies are going down but the weaker companies are coming up, does that indicate that perhaps the better companies might actually make a bit more of a rise? So again, I don't think it's a very simple explanation as to why small caps and will move in certain directions compared to the Dow. But I'd be very, very careful about looking at just small caps versus the Dow. Certainly you can look at the Russell 2000 or even the Russell 1000. There's some great correlations between the S&P 500, NASDAQ and Dow. But also you can compare this to other major economies. So the UK FTSE 100, you can actually hedge out the currency risk there and trade the FTSE against the Dow or the FTSE against the NASDAQ or whatever you want to do. So there's also those sort of international transactions. Canada, you've got the TSX. I do this for a living, right? The TSX 100. My way off. Is it the TSX 100? I think it is.
Thank you. TSX is a wonderful exchange. Even better than TSX was Vancouver Stock Exchange.
Well, yeah, that was the Wild West.
Vancouver was fantastic, and I was trading a lot on Vancouver, and I had a couple of my companies trading on Vancouver Stock Exchange, and that was a fantastic days.
But I have to make my disclaimer, and I want kids, don't try this at home because Shakeel is a professional. And
absolutely.
We're talking about
actually, Jim, don't worry about the kids trying something what Shakeel is doing, because they just have no. I mean, most of the people what I would think is our audience. I would think, maybe I'm completely wrong. Maybe we have audience of all fund managers, and I'm just not aware of it. Yeah. Most of the people, they have.
I hope I can get all this hate mail tomorrow. Stop telling them that we're no good because we beat the market by 1%. We only lost 14 when the market lost 15. We're brilliant. We just
no. Most of the people have probably 5, maybe 6 figures portfolio. So if it's 5-6 figures portfolio, nobody can even touch or even closely approach anything whatever Shakeel is talking about, because you need 8 figures, 9 figures, most like portfolio to short FTSE and buy TSX. Come on.
Well, that's not entirely true.
If you don't have an American Express black card, you're out of it. You can't, hang with Shakeel.
This is not something that I advertise, Jim. American Express may not be in my good book, so let's not advertise the black card just yet. But no, look, that's not entirely true, Sasha, because there is obviously the ETFs like we've talked about, and there's also futures contracts. So people can do this. What I'll say to people, and again, look, nothing that I say is financial advice. It's just my opinion. It's just, what we call in Australia, my 2 bobs worth. I'll say two things. One, start out small. Even if you're a multi-millionaire, start out small. There's nothing wrong with paper trading. I will still paper trade. Even today, I'll still paper trade some strategies. And I'll tell you, I have had some strategies that sound absolutely fantastic, and we've modeled them up, and they're terrible. In fact, the majority of the time, the most brilliant ideas that I've got that I can't believe nobody else has thought of, I'm a genius, and we model it up, and it looks great, and then we trade it live, but not with real money, right? We trade it live and pretend that we got executed, and the vast majority of them fail dismally, right? And you just find those handful that work, and that's what it is. It's the challenge and the strategy and all the rest of it. So I'll say that, but the other thing is that no matter how much you paper trade something, it's like learning to drive a car. No matter how much you read about it, until you've actually jumped in the car. You can have a PhD in how to drive a car, but until you've actually sat behind the wheel and, you know, try to change gears and all that sort of stuff, like, you're not going to know how to drive that car. So what I will say to people is, when they first start out, just take a few $1,000s, something that's affordable, right, and expect to lose it. And what you're actually doing is, it's not that you're deliberately going to lose the money, but you're paying for your education. That's what I would say. Because there's a certain amount of education that only experience is going to give you. Take some small positions. When you take small positions, your brokerage figures are so high that you're probably not going to be profitable anyway because of your brokerage, your minimum ticket fees. But do it anyway, just to kind of get a bit more of a feel for things. Then when you feel a little bit more confident and you've got sort of the hang of things, then you can put a little bit more money in and a little bit more money in. But don't just, you know, you're worth $3 million, you've just sold a house for $1 million, and you just go drop $1 million in the market. I mean, you know, please don't do that, because, you know, the worst thing that will happen to you is you'll make money straight away. And if you make money straight away, you're going to think, I'm a genius, I've worked it all out. You know, Jimmy told me, buy low, sell high, I've got it, it's perfect. And then you start taking too much risk. And I say that because I've done it more than once on multiple occasions, thinking that I was a genius, thinking I was the best out there, I was the hot stuff, and it ended in tears multiple times during my life on my personal account, and I've had to learn the lesson. So hopefully those watching, that can save them some pain.
Excellent. What I would like to add before we finish our program is one well-known grandmaster, Levinfish. He was giving a lecture in Moscow in Central Chess Club. And after the lecture, one of the amateur chess player, he walked to him and say, Mr. Grandmaster, could you please tell me how I can quickly make my play much better? I would like to become much stronger than I am right now. He says, you play your game, but play for a ruble. Once you will start playing for a ruble, you'll see how your game will start improving, because you can't afford to lose, right? Okay, thank you so much for participating in today's program. In next program, next Wednesday, I will tell you a fabulous story about what's happened at the end of the 90s. Shakeel was probably a kid at the time. He may not remember that. But Jim, I'm pretty sure he knows the story. Actually, it happened in Canada. Thank you so much, and see you all next Wednesday at 1 o'clock. Bye-bye.